So now we're going to look at how do we record revenue based upon the concept of accruals. So in business accounting, as in personal accounting, the accrual method is used to record transactions. Revenues are recorded or recognized when they are earned, regardless of when the cash payment is received from the customer. Recognizing a revenue or expense means recording it on the income statement. There are three different scenarios for which cash is received. So either the payment is going to be received before the service is performed or the products are sold, or the payment would be received at the same time that the service is being performed or the products are being sold, or payment is received after the services are performed and the product is sold. In all cases, equity is going to increase only when the revenue is recognized. And so we'll look at this in the case of when cash is received before the service is performed. So when a customer pays a business for services before they are performed, it is known as a customer deposit. And so sometimes examples of this might be a banquet hall. So if you're renting the hall out, maybe for a wedding or an event, you have to put down a deposit before your event. Health club memberships, sometimes you have to do that where you have to pay in advance of you going. Magazine subscriptions, that's one where you pay for 6 months or a year in advance. Insurance premiums, that's another one where sometimes you'll pay for 6 months or a year all at once. So those are examples of this. And so the cash is received, which increases our cash. It also increases our customer deposit. And then, which actually ends up creating a liability for us. And then once the service is performed, it increases our revenue and it decreases our customer deposit. And so let's say that a business receives a deposit of $1,100 from a customer 1 month before the services are provided. And so the prepayment by the customer is a liability of the business's unearned revenue. So we either have to perform the service that we were contracted for, or we have to refund their money if we end up not being able to do it. The prepayment by the customer is a liability for the business, it's unearned revenue, because the business now has the obligation to provide the services to the customer. Revenue can only be recognized only when the work is completed the following month. So we see that we have an addition to cash for $1,100 and we have an addition to liability for $1,100. And then notice that our accounting equation, our assets equal liabilities plus owner's equity, that then stays in balance now. So we'll talk about example of when cash is received at the time that the service or the product is performed or provided. So when a company performs a service and the customer pays for it immediately, cash increases and equity increases both at the same time. The increase in equity is recognized as revenue and it increases our net income. They both happen. And again, this happens a lot. We buy groceries. We obviously receive the items once we pay for them, at the same time. Or the other day, I had to take my car down and get the oil changed, and I paid for it at the same time. So they did the service, and then I paid them for it at the same time. So if a client pays $1,100 immediately and the business provides the service, then cash and service revenue increase by $1,100. Owner's equity also increases by $1,100 as a result of the increase in services. So we would debit cash in the amount of $1,100, and then we would credit our service revenue or sales revenue for $1,100 at that time. And so again, our equation then would remain in balance. Now, let's say that cash is received after a service is performed. Most businesses provide customers with payment terms which allow customers to pay after they've received the product or service. After a service is performed, the seller issues an invoice to the buyer. The invoice includes details about the services rendered and the agreed upon price. And so an example of this, it might be maybe a dentist, they might do that where they don't collect up front. They go ahead and bill the insurance and they're going to send you a bill after. Or trying to think what else. Or Obviously, utilities, that's one where utility companies, they'll do that. Well, they send you a bill after. So after the service is performed, as I said, they send an invoice. So the invoice includes the terms, as we said. So the service is performed, we're going to increase our revenue and increase what's called accounts receivable, which is an asset at the time that the service is performed. And then once they pay, we'll increase cash, decrease our accounts receivable. So we see that over here that our asset is accounts receivable. And then we would credit our service revenue. Business provides services valued at $1,100 and sends an invoice to the client. So what we'll do is we'll increase accounts receivable, which is an asset, and that is an increase in equity, which is known as revenue. Later, when the customer pays the invoice, cash would increase and then accounts receivable would decrease. So basically, they'd wash each other out at that point. Equity is not going to change because one asset is simply being exchanged for another. Let's look at this hypothetical. In January, a company receives a cash deposit from a customer for a service that will be performed and completed in February. So which of the following statements are true? Is it that the owner's equity would be increased in January? Is it that the receipt of the cash deposit is recorded only after the service is completed? Is it that no accounting transaction is required in February, or a liability increases in January? And it's D, that a liability is going to increase in January because we have then an unearned revenue. We would increase our cash, and then we would have an unearned liability for unearned revenue. And then once the work is performed in February, then we've earned that revenue and we would be able to move it from unearned revenue into revenue.